Welcome to the Dividend Talk podcast, episode 84, the start of earnings season. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to talk about earnings from popular European and US stocks. See you on the inside. European DJI earnings season has started. How does that make you feel?
Oh, really excited, EMF. And you know why?
Why?
This is the time that we get all the European dividend increases. I know that this week was still a lot of American, but next week, Royal Dutch Shell is also coming out. So big cash flows coming up.
Yeah.
But and then afterwards, Ahold and everything. So we will hear all these annual dividend hikes. I've got really high expectations. Probably easy to disappoint me, but I'm really, really looking forward.
Yeah, it's a really big time for European companies. So I'm looking forward to what's to come. We do have a couple of European companies this week with some massive hikes. I know we'll talk about some of them coming up, like Louis Vuitton and stuff. So we'll get to it. Uh, Usually we talk a little bit of news. To be honest, we have so many so many companies that we want to talk about. I only have something small, which is around Pfizer. Pfizer have got their pill approved in Europe for COVID-19. That was very good timing for me actually because I sold a put option on them. I wrote it in my blog. I do a little screener and sold a put option, and they obviously jumped in price because of on the back of this news. So it's good news for option sellers like me, and good news for Pfizer obviously because this is going to be recurring revenue now from COVID.
So this is a pill that you take when you get the early symptoms of COVID, right?
Yeah, yeah. And
Yeah.
I believe there's another company. It's gone for me that in the states have approval in the states. Merck, is it Merck? I think Merck have
There
approval.
might be. Yeah.
But yeah, it's. I mean, Pfizer have got approval in Europe, and I believe the UK have bought something like 2.7 million pills or
Yeah.
something like that. So they've already started to take in orders for
Oh, I wonder what the anti-vaxxers will think about a pill.
it. Well, they could be anti pills as well.
Yeah, exactly. The anti-pill movement. I can see them already marching through the streets.
But yeah, but it'll be interesting to see how it reduces or what effect that has. I suppose with the vaccine now going to be annual, I believe, in most countries. This with the pill, it should hopefully allow people to move on.
Yeah. So I saw a warning from the scientists that we shouldn't think now that the virus will continue to be weaker and weaker because it really depends on the mutations that we will be seeing. So it was kind of don't celebrate too early, and scientifically that's correct. So let's see if that is indeed what we end up with, because so far all the time the expectations that we have are disappointing us half a year later. So I'm a
Yeah,
bit
yeah.
on the side on this one. But
Anyway,
yeah, we don't like COVID stuff anymore. It's good
yeah,
for Pfizer. I don't own shares, so
yeah, yeah. I was saying it only piqued my interest because of my option trade, and other than that, I wouldn't have blinked twice at it. Yeah, but that's enough now of COVID-19 talk. We have plenty of companies here, plenty of earnings, plenty of good news and maybe some bad news to talk about. So we move on and talk a little bit about some of the companies we've looked into this week. I might start because one of the companies that really interests me is a company called Teradyne, and that's ticker TER. I suppose for me personally, they stand out because of their industrial automation segment. Um, I don't know if you know, but they own Universal Robots and a company called MIR, which is mobile robots. And in the place that we work at the moment, we do use Universal Robots, and more importantly, we've brought in this MIR mobile those actual MIR robots in. They're quite cool. They're really easy to use. I love working with them. Very flexible. It's given us a whole new dynamic in work that we never had before. What I will say is that their support in Ireland not so good. But I believe their support in Europe and the US is a lot better. But I'm all interested in the company because of those. That's what led me to them, and I follow them quite a bit. And they've had quite a good year actually. Again, the share price took off really over the last 2 years, and you can see why. Last year they grew revenue by 17%. And so they had revenue in the quarter, they had nearly 1 billion, so nearly 900 million revenue, so 17% growth. Earnings per share grew about 29%. Universal Robots, which I spoke to you about, grew 22% in that quarter, 41% in the whole year. MIA revenue, which is the mobile robots, grew 46% in that quarter. That could have been because of my company, I don't know. And they also grew 42% in the year. So they're really, really big numbers. The quarterly dividend increased to 44 cents over the year. So they have a really tiny, that they would not interest you from a dividend yield point of view. I think it's 0.3, 0.4%. But their growth is quite good. So it's a company that I like. I would not be buying them above 100. I think they were $120 last time I looked, maybe as low as 110. I wouldn't be buying them anywhere near that price, but it's a company that I really like, and I will be looking out from. The one thing I will say is that if you are looking at them, they have said that they expect 2022 to slow down, particularly with their semiconductor segment. So they rely a lot on companies like Taiwan Semiconductor and Apple. They make the chips for 'em. And we know that they've pushed out some of the technology, the 3 nanometer technology, to 2023, because they're so heavily reliant on, I think it's about 4 or 5 companies in that segment. It makes up 65% of that revenue. So when they push that out, it obviously has a knock-on effect. So that's something to be aware of in 2022, but then they'll make that back up in 2023.
Cool. Yeah, I think it's always nice to follow companies that you use at work, right? For which you use their equipment, because you can actually get constant feedback on how the company is performing, which
Yeah,
is in some cases for the companies that we discussed today really, really difficult, right?
yeah, and that's how I found this company. It was through research of these mobile robots, and I came across them. And the Decline Capitalist had actually mentioned Teradyne before, so it twigged. And we know he's great at finding little
Yeah.
gems like this. And then when I put the two and two together, I started researching, and they're really, really nice company actually.
Yeah. Super, super. Well, it sounds like at least need to have a look at it and look a little bit at the product. I said product portfolio. And are these robots like with 2 legs and 2 arms that just walk beside you, or are you talking
Yeah,
about different kind of robots?
no, they're mobile. So they're like cars. They're like cars, and
Ah, okay. Yeah, yeah,
so
yeah. Gotcha.
we've had
Okay.
to modify them to suit our needs, but we
Yeah,
put product in and out, and they carry them from one place to the other quite quickly as well, and they're quite
nice.
intelligent. If I was
Mhm.
to walk in front of one, it will stop and go around me and find its way in.
This must be so awkward in
No,
the
no,
workplace.
no. We thought that, and when we were setting it up, you have to do all this testing. So you test that, and you have to make sure it doesn't crash into people or crash into barriers, and you do all kind of awkward stuff. But on a day-to-day basis, honestly, we just walk as normal. You forget they're there. They just navigate around you, and away they
I will
go.
talk to my boss because it sounds like the perfect coffee delivery system for in the office.
It, right, actually, right, you love this. When we started testing them, we had no machines to test them, so we wanted to make sure that they were working. So we used to, we used to deliver coffee down to the office, and and honestly, it was perfect.
Really expensive, probably for only such a service, but
Yeah,
nice
yeah,
one.
worth it, completely worth it.
Cool. Now that we're in that space, right? I think I saw already some questions on Facebook. Let's also talk a bit about Intel because they also reported their earnings and yeah, 8% down.
Yeah,
And that was massive, right? And we know that Intel is one of the darlings of the dividend growth community.
yeah,
Actually, I also started initiating a position in it. I bought also something after the earnings decline because look why the earnings went down. And I also made a video about it today, actually. So if people want to have a longer story around it, look me up on YouTube. You'll see my last videos about the Intel earnings. But effectively, the gross margins are declining where in 2012 they still had a gross margin of 62%. Now they are forecasting, let's say 52%. I read even somewhere later on this evening also 49%. And this has to do with the increased cost basis. But this is here to stay, and it should not come as a surprise. And that's what I'm surprised about, right? That it continuously comes as a surprise, because on their day in November, they already said we will have lower
Yeah.
margins, right? Now reality kicks in, and then the guidance seems to be still disappointing to people or investors. So I don't know, maybe they only look once a quarter at the company and not in the events in between. I don't know why that is. And yes, there is something, what I read also in the commentary later, that Pat Gelsinger is not answering the questions that some investors want to have. But I think, like, yeah, he should answer them straight, right? But if I look at the earnings transcript and I read all of it, I just see a guy on fire. Yeah, he's taking a shit situation that Bob Swan, his predecessor, created, and the predecessor before, and he's turning it around. And when you're in a turnaround, these are typical days that you have. Yeah, this happens. We saw it also 3 months ago. Quickly, it came back again to the price from before. Might do it again, might not do it, might stay here for longer. But this is a turnaround play now. And I believe now, based on the investments, as soon as the first, I think they call them shells, come up, and they actually, what is nice, Pat Gelsinger says, like, we start with the buildings. We ordered, of course, something at ASML, and then later we'll figure out if this will be the foundry or the design. But we need to start building this stuff already, right? At the same time, they have this CHIPS Act that is in front of Congress with 52 billion.
Yeah.
So I see a lot of catalysts here. I feel like they're probably somewhere this year reaching the bottom of their how is it of how much they are behind AMD and TSMC. But I see the hockey stick coming up soon, and this will not be translated in earnings yet. Yeah, this not yet, but we will see it in product launches first, all these kinds of things, and then after that, earnings will come as a follow-up. So that's why I started to buy, because with Microsoft, I noticed that's the time to buy, like 1 year before you feel that this will kick into the numbers, because once it gives some evidence in the numbers, the stock shoots away because it's being pressured down because of this market sentiment.
I think it's too premature to say that he is turning it around. I think he's laying the foundations to turn it around, but I don't see the evidence that it's turning yet, because, like you said, that year beforehand is always going to be a struggle, and whether it works or not, we don't know yet.
We don't know. No,
we don't know, but he's certainly making the right moves. And like you, I am, and I'm not surprised about the price drop, because if you remember in a chat that we were having on Twitter with some of the community, and they're talking about buying puts before earnings, and I made the comment, I don't know if you should. This will probably drop after earnings, but I suppose our community are maybe more bullish on Intel, and maybe that sentiment was taken over. But I'm not surprised, because one, they haven't done anything yet, and people do have a short-term focus.
Yes.
And what I think, and what's been happening over the last 2 or 3 quarters, is earnings come out, the margins go down. They don't really give you much in terms of guidance. What's going to happen? It's very light on that.
Because they can't.
Yeah, but they can't.
Yeah.
But what they do is that they say we have an investors day on, I think it's early. Early. So what happens is earnings come out. They don't give much on that. It goes down. Investors relations day come around. They hype it up. Investors go, oh, actually, no, this sounds good again. Then they start buying. The price will go back up. And that's the cycle we are in at the moment, until they build their buildings and they start producing. So that's, I think I said that, Joe. I was in no rush to buy these above 50. I had full confidence they're going to come back down. I bought some shares. I sold some put options. Whether they get a sign or not, I don't know. I don't care if they do. I want them to, but I believe it will go back up over 50 after the investor relations, and then next quarter the same cycle will happen.
I think as well, until they nail it. And we need to see evidence in the numbers first. We don't see it yet. There was a large impact of working capital on the current cash flow. So I also have sometimes a feeling that they do this kind of to under promise and later over deliver. Because they are setting themselves up for next year, beating their free cash flow a lot, because of the working capital issues.
Yeah.
These issues are to do with accounts receivables and inventories, right? So there is some performance in these numbers as well that could be better, but other than that, I didn't see anything that bad in the numbers and in the guidance that for me justifies, because 8 or 9%, right, in 2 days is a really steep market decline. This is
Yeah.
not like a near miss. This you should usually consider as a big miss.
Yeah. But I mean, you're talking a lot of people, a lot of comments to me, the margins are down, the margins are down. The margin is down over the full year from 56%. This is gap, right? Gap,
Yeah.
56% down to 55.4. You're talking about 0.5,
Yeah, but the
0.6.
guidance is going to 52, 51. So I
Yeah.
calculated that, right? So I think what is the earnings per share at the moment? Is it like 4.8, 4.86? I
Yeah.
calculated that just on the back on the napkin. We're talking about an earnings per share if you would have those margins around 3.90, $4. That is a big drop, right? And I did it just like by deducting it, taking 2021 in account,
Yeah.
taking lower margin, letting it filter through the income statement, and then I came to such an earnings per share. It is a big drop, yeah, and then your multiple goes up. So from that point of view, it makes sense because a 3-4% how is it difference in margin trickles down to probably 15 to 20% lower earnings per share. So it is not a little thing, but what I mean with it, it has already been widely communicated.
Yeah. Yeah. And it's- I think investors have a short-term view, really, because nobody seems to be looking at the bigger picture here. You have to be aware that this is, as you said, a turnaround play. Quite clearly, it's a gamble that is going to turn around. And that's where you are. If you're invested in this company, it has to be for that reason, because
Yeah.
it's not making money not making your money in terms of total return at the moment. Dividend growth is quite slow. Capital
Yeah.
appreciation is slow. So you're not betting on it right now. You're betting on it in the next 5 years.
5 to 10 years.
Yes.
Yeah. And for instance, I would never buy Intel if it would be of my first 10 stocks. I wouldn't.
Mm,
Yeah, I'm talking here about a portfolio with already 40 stocks in there. So I
yeah.
feel really comfortable with this. I typically have 2-3 turnaround plays, and that's fine. But if these will be my core holdings, my core 10 holdings, I think there are 10 better other stocks than Intel out here.
Oh, 100%. 100%. For me, they're in the same bracket as Walgreens. I'm in that same
Yeah,
category.
exactly.
Okay, good. And as you said, check out your video if you want the more in-depth knowledge of your thinking and how you feel about the company. But I saw nothing in there of concern, so I'm still a happy investor. Let's move on to Texas Instruments. I mean, for me, they are a lot like Johnson& Johnson. They are just like clockwork all the time, just ticking along, pushing out big numbers. I mean, revenue increased again 19% year over year. Some of their industries have done really, really well. Automotive is starting to come back around, so that's maybe suggesting that maybe the chip shortage is starting to bottom out and starting to get a grip on that. And what I really love about this company, if you read through the report and then you go onto their website and just about us, they focus on cash flow, growing
Yes.
free cash flow, and I love it. I love seeing that. Um, it is printed everywhere. And one statement I just want to read out that said, "We believe the growth of free cash flow per share is the primary driver of long-term value." I agree with that. Like that just suits me down to a T, and it's a company that I love. And they give you all the growth estimates in free cash flow. So 12%
Yeah.
free cash flow per share annual growth between 2004 and 2020. I mean, it's
So I was looking into the company last week. I also
yeah,
included in one of the videos, did a further analysis on it for myself. It is like 5 to 10% above my fair value price. So maybe I don't know, maybe I'm a cheap Dutch guy. I don't know, but it's like just like so nearby and I didn't buy it yet. But I'm thinking like maybe I should just buy one share just
Yeah.
to have it in my portfolio
Yeah.
to honor this management. Because to your point, they align so much with what I want to have 20 of those companies in my portfolio with such a philosophy.
Yeah. Yeah.
This is what creates long-term shareholder wealth and long-term dividend growth.
Yeah. And I mean, they give you usually companies give you their payout ratio against their earnings. They give it to you against their cash flow, which is
Yeah,
62%.
exactly.
So there's plenty of room for that dividend to grow. I'm like you. I find it really hard to value this company. I never expect them to grow as much as they do. Every year they seem to just post big numbers, and I don't expect it. And I should maybe, so I have them priced a little bit high. So then when I buy them, I buy them in trenches of 1 share or 2 shares.
Yeah.
But I really want to own a lot more shares than that. So I add them in drips and drabs, one a month here, one a month there, and try and build up from there.
Yeah. So my analysis tells me that their fair value is $166.
What are they trading at now? Is 173 ish?
Yeah, something in the high 170s.
Yeah,
Yeah.
yeah. Buy 1 or 2 shares.
I should, right? Okay, I'll do the Monday.
Okay, let's get some European companies in here, shall we?
Yeah, in the end, we're a dividend talk. Come on. Have you heard about Louis Vuitton and their numbers?
I saw briefly online their numbers and they were quite
Okay, so
staggering.
brace for impact. Revenue 44.5 billion last year. This year 64.2 billion.
Wow.
A change of 44%, driven by a 36% organic growth. I mean, this is insane. They're fashion and leather goods. So I believe all these bags, right?
Yeah.
21 billion to almost 31 billion. I mean, I still need to find people in my surroundings that have Louis Vuitton. Says a lot about my surroundings, by the way. But I still need to find them. And somehow they found a lot of, I guess, women, maybe some guys for a belt as well, that bought for 31 billion in these kinds of handbags. I mean,
It's crazy. Crazy. I mean, I they're not in my circle, but in my wife's circle, she has a couple of friends and they are very into fashion and they buy a lot of Louis Vuitton bags and I can tell you they are certainly not cheap. They are not cheap.
no, thank them for us, although I'm not a shareholder yet. But the second part on that, because we always complain about European companies, right? They hiked their dividend from €6 to €10 per share. Well, that's good to know. They lost their dividend aristocrat status as a European company in 2020 because, as part of the pandemic, they cut their dividend from €6 to €4.80. Then
Yeah.
last year they hiked it back to €6, but now they hiked it to €10. When you see this kinds of stuff, yeah, I wonder why did you guys do this? Is this policy so important? Yeah. Uh,
But
it's such a pity because it drops us off as well, right?
if you look at it, we look at it as a status, okay? They've lost their status, okay? But think about it from their point of view. We've got this crisis coming in. People are locked down. What do these guys sell? They sell luxury goods, right? People are not going out. You don't need to buy a Louis Vuitton bag. Who's going to see it? Okay, you don't need to buy the watches, the jewelry. You might not even buy the spirits or the wines. So in their mind, we'll cut the dividend now. We protect what we have, and then if we return back to growth or if we exceed, we'll increase it, which is exactly what they've done. I just think it's good management. I really think that's good management.
I think it's also good management, but I'm egocentric here because I'm a dividend growth investor.
Yes,
Yeah.
yes, it is. But I have no problem with a company doing what they've done. I do have a problem with a company that would cut it and then return back to where they are and not either reinstate at a lower rate.
Yeah, so what, for instance, NN Group and ASR did, the insurance companies in Netherlands, they reinstated it once they were allowed from the central banks again, right?
Yeah,
Then they paid it even with the next dividend. That's what I like. But this one, I feel like, at the moment when they cut it, I already found it like premature.
mm,
And yeah, that's what I really think. I think they were really conservative with this one. And why is this important? Look, in a diversified portfolio, it doesn't matter too much, right? If you have one such a stock that cuts the dividend by 20%. But imagine EMF if you're living off the dividends and you've got like 5 or 6 of those companies in there.
Yeah, that's true.
Then becomes a different story, and that's why I am picky on those companies to continue to increasing the dividends. Like you say, it's good management. Probably if I would be it, I would do the same. But if you know that you have like thousands of people living off your dividend, I think you have also a bit of a responsibility there, at least towards me. But
Yeah,
hey, I don't own the share yet, so maybe they thought like, oh, if EDGI doesn't have the shares yet, we can cut it.
yeah. But no, but that's a valid point, because if you are living off dividends, you probably are in aristocrats, whether European, Canadian, or US. You are more than likely going to be in aristocrats, because they're the ones that are quote unquote safe or safer.
And that you can count on during
Yes.
stress.
Yeah.
Yeah.
Yeah. But that's why we diversify our portfolios with companies such as Intel.
Yes, exactly. To create some other shit in the portfolio.
Exactly.
Okay, hey, then another one, our German SAP. They got quite hammered also after the earnings. And I can tell you, it's similar story to Intel. Their guidance was not strong enough. So, from that point of view, if you look at the IFRS numbers, right, they went down in the fourth quarter from €1.62 to €1.24. But from a non-IFRS, so more like comparable numbers, they went up from €1.70 to €1.86. Their cloud business is growing finally. So somehow they're able to get their people transformed, or get their clients transformed to the cloud, because no company can do something with their shit as a software. It's really shit. But they have a really, really strong lock-in, and they seem to be the only ones that have the key to get those people, those clients in the cloud, and they earn money of that. So this is good. So I hate their software. The usability sucks. I love their monopoly and their business model from that. So they're growing cloud, but investors are impatient because SAP is really, really one of the last dinosaurs out of the IT world, even later than IBM, that really started shifting to the cloud. And they're just impatient because you see the numbers of Microsoft, you see the numbers of other cloud vendors. Then SAP is just not hitting the mark when you compare them with the industry peers. That's why the share price is down. You can get it now at a non-IFRS EPS multiple of 18, which is cheap for a company like SAP.
Yeah.
I expect the dividend to be announced sometime soon. I didn't see the dividend announcement yet with the press release. I think it probably comes with the annual report. So mixed bag, generally okayish numbers as what I would have expected from SAP, but the market is not happy enough.
Yeah, but look, it's good to see cloud growth, because that's essentially the future of it, really, isn't it? That's where they're going to make
Better
their
late than
money.
never, right?
Yeah, yeah. So,
Yeah.
I mean, they are extreme laggards in that scenario, but they have such a lock in. They can afford to be laggards. That's
So what I did last year, after my analysis at that time, I bought some shares for I think €95,
yeah,
and I sold them at 125 because when it was there and I saw the earnings coming in, for like, okay, no, I'm pulling out again. I might come back one day once they really hit the mark again, but now I thought like, no, this will take me too long to get any proper dividend return out of this.
Mhm. Okay. And there's a company called ELISA. I think you
Yeah,
might.
ELISA, and I wanted
ELISA.
to touch upon this one because we've never spoken about a Finnish company here.
Nope.
And I know we have some listeners from Finland. So to everyone listening from Finland, this one is in honor of you. We're at show 84. It's about time we get a Finnish stock in here. So ELISA is effectively their national telecom provider. And what I like about this company, actually, before I even look into the numbers, that they have been growing their dividends since 2005. In the period between 2005 and 2011, I believe they gave a lot of special dividends. There was clearly going something on in the company there. But they have been just growing the dividends, and they just hiked it from €1.95 to €2.05. And unlike other telecom companies in Europe, like Vodafone or something like, or Orange, where you cannot count on the dividends,
Yeah.
we've got one in Finland. It's currently yielding at a 4% dividend yield. So I find it in general an attractive company. And if you look at their revenue, it has been growing again with several percentages to 500 million effectively. Mobile is going up. Cash flow went a little bit down due to capex. I guess it has to do a lot with 5G. But what is also nice about Finland as such, that it's quite a progressive company when it comes to adoption of technology in IT. So they're always a little bit on the edge here of innovation from what I've seen. And yeah, I think it's an interesting company to do some further deep dive on and to see if I really want it in my portfolio. I don't have a telecom yet. I had for a while AT&T, also a dividend cut with the spin-off. So this is probably one of the few telecoms in the world where you can still see a growing dividend. With Verizon, yeah, but the most of the popular ones have all not such a good track record at the moment.
A growing dividend, and looking at their share price, it is going up the way, unlike AT&T or Verizon, which is flat or dropping. So they look like an interesting company. And just reading some of the highlights, and in the highlights they have prepaid subscribers decreased by 10,300. I don't know if that's a highlight or a low light, but I mean, I don't know enough about the company, so it's definitely one that I'd like to look into a bit more. You can buy them in euro, can't you? It's not, they are
Yeah,
euro.
yeah, yeah,
Yeah.
yeah.
So
Well, the financial highlights are, as how I know Finnish people, um, often quiet, but when they say something, it's meaningful and direct.
yeah,
Yeah.
yeah, bit like Dutch.
No, they make a lot of noise and they're still direct and considered rude. Finnish people are not considered rude. Think about Formula One and Raikkonen. Come on, he's the perfect example.
Yeah,
No
that's
bullshit.
yeah,
He delivers.
straight to the point.
Exactly.
No, interesting company, and probably one of the better telecommunications to look at. So we might cover them on our show. Maybe it might
Yeah,
do that.
yeah.
Might be,
Maybe we
you
should
know,
interview the CEO.
yeah, that'd be awesome. Let's try and make that happen. The next, we'll go back to some American companies now. So we have Microsoft. I mean, there's not a whole lot we can say about this company that we haven't said before. They just knocked it out of the park again. I mean, they just keep hitting revenue 19, 20, 21% increases year after year, quarter after quarter. I mean, it's just,
How can you get used to this, right? I can't. I see people getting used to this, but I cannot get used to a 20% revenue growth of a multi-trillion-dollar company.
but I mean, you know what's going to happen, right? They'll post a high single digit growth number and their share price will tank. I mean, it's going to be,
Well, I will be there with the truck waiting for it to load
yeah,
it up.
yeah. But because people are just getting so used to these huge numbers. I mean, 20% is becoming the norm, which is even crazy to say that out loud, but that's
Yeah.
becoming the absolute norm with these guys. So
So when I did my fair value assessment of Microsoft, I believe I was calculating with a 15% growth, yeah, on earnings.
yeah,
So and then I got to 250 fair value, and people were telling me it's too high. And now they, now they have, like, what is it? An increase of 22% again, also in earnings. So I was underestimating the growth potential of this company. So for me, around 300, 280 is probably still at fair value. So if people
yeah,
bought the dip, I congratulate them. They've got a really great stock in their portfolio. Of course, it can go down to 100, it can also go up to 500. That's why we invest. I'm just wondering, like, when will Satya Nadella ever become one of the richest persons in the world? I know that he's not a founder, but for me, he deserves to be in the top 5 at the moment. With his leadership skills, he deserves to be one of the richest persons in the world.
all he has to do is load up on shares. He's laughing.
Yeah, yeah, exactly. Options.
Yeah, so I mean, look, we could go deeper. We've spoke about this company
Yeah,
a whole lot. Well, what's actually interesting for me is the Xbox content that has grown 10% or grew 10%, and that's without this new deal
Activision.
that's going to go through. So could you imagine that's going to start hitting 20% at some point as well, and you're going to have every
Yeah.
single segment hitting 20%.
Yeah, exactly, exactly. Yeah, but it's amazing company, and like you said, we often mentioned it really often. So Let's go then to the next one. Visa.
Weren't Visa dead in the water there about 3 months ago when?
Yeah, Visa was dead 2-3 months ago. Yeah. Oh, fucking hell. Come on. Because the UK, I said Amazon UK didn't want to accept Visa payments. I mean, like the
Oh,
UK matters from that point of
yeah,
view,
yeah.
right?
No, only Visa credit card. So Visa debit card
Yeah,
was
yeah.
was fine.
And they
Oh,
reinstated it again, right?
of course they did. Of course they did. They had to.
So it was just above my buying price, and then I'm really disciplined in this. That's why I don't own those shares yet. Yeah, but everyone who bought this in the dip, you did an amazing job, because revenues up year over year, right? From a Q1 point of view, what we're talking about now, not full year earnings, 24% up, earnings 29% up. No wonder that the stock went 10% up. These are just awesome numbers. Payments volume increased 20%, cross-border volume 51%, and they earn a lot of money on this stuff, right? Cross-border. So, in my opinion, they knocked it out of the park around Christmas. Effectively, that's what we're talking about, right?
Yeah,
Massively, people spending money, and I guess the lockdowns helped a little bit with that. Still, all over the world around Christmas.
yeah, yeah.
So it
Buying
might
online.
also be a bit boosted because of that. But if you look at this company, and they're the highest margin business I've ever seen. What do they have? 80% margin or something like that?
I mean, where could that cost actually be? Like, I mean, the cost
Yeah,
is passed on to everybody else. I mean,
exactly.
the banks
And
have to use their own equipment. I mean, it's a
yeah,
brilliant.
yeah, yeah. What I even, when I studied the company, what I found amazing was that even the logo on your bank card, right? They get royalties for that. Yeah, because they don't create the bank cards, the credit cards. It's what the
Yeah,
banks do. They,
exactly.
they they pay Visa to put the logo on it, because then people want to take their credit cards because they know it's supported by Visa. That's what I call a moat.
Yeah,
And people telling me that fintech will kill this, I don't believe that really quickly, because it has such a brand power. Of course, if they don't do anything with it, all good companies can go bust in the end. Um, but if I think they could really, really also do something with blockchain here, and I believe they are already doing so.
yeah,
I don't think they will be easily wiped out by a fintech company, and the only thing that could prevent them from being successful is like internal stupidness. But I think they have all it takes to be still there for the next 20, 30,
yeah.
40 years.
And themselves and Mastercard really, I think, have huge opportunities. And you actually took the question out of my mouth. I was going to ask you because you hear this fintech companies are going to disrupt it, and but these guys are on the cusp of that as well. I mean, they're not going to be
Yeah,
easy to overturn. A fintech company might come in, but they're never going to overtake these guys in 1, 2, 3, 4, even 5 years time. It's going to be
yeah.
next to impossible.
Yeah, 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 exactly. And Visa doesn't come across as a company that is not watching what's happening outside. And secondly, it doesn't come across as a company that doesn't understand the external pressures and what it takes to fight them.
Yeah,
Maybe I'm wrong. Maybe if there's a person listening to us that works at Visa tells us like, no, this company is poorly managed, it's lazy, we are asleep, let us know. But this is not the feeling I get from studying their materials.
yeah, yeah. I know it's a brilliant company. I remember when that price dropped on that news, I sold a put option. Um, and I had them and I had Alibaba, and at the time I was expecting a quick bounce on both, and I wanted to hold on to the Visa ones and not the Alibaba ones, because I was expecting. But what actually happened was reversed. That bumped up. Alibaba didn't, so I was forced to sell that one early because of margin and to keep it. So I'm quite disappointed with with that outcome, considering how well they've done. But I mean, it's a company I would love to own, but it's a company. It's one of these companies. I've spoke to Dividend Wave. They always seem expensive. It was like Microsoft. They always seem expensive, but then when I look back 6 months later, I should have bought them 6 months ago. And they're always that type of company for me. And I just don't know how to value them. And I might just have to do what I told you to do with Texas Instruments. Just buy a couple of shares. Just
So first, watch my video about Visa. I made one in December. It will tell you how I value them, and I think it's still conservatively. when the price dropped, it was really near by my buy order. It just didn't trigger it because I don't feel like overpaying for a company. But probably I was too greedy there as well, 3-4%. But I am greedy when it has a low yield in return. So it's
Yeah.
simple like that.
Yeah. Good. We'll move on to some questions from our listeners.
Yeah, the first one is from Lawrence Hembrook, and he is asking like, when you are investing with a limited budget, let's say €100 per month, would you rather buy one or two more expensive stocks? So like I guess €50 per share, or would you opt to get multiple cheaper stocks?
I think you're asking the wrong question. I think you need to keep your fees as low as possible.
Yeah.
If you buy one share of €100 stock or two shares of €50 stock, it doesn't really matter.
No.
It's really your fees is what's going to kill you with investing at those low amounts. So I would keep them as low as possible, and that probably means buying one company a month and so on.
I would look. Usually we don't pitch brokers here, right? But I would go in this case to Trading 212 because they have fractional shares, and I believe Interactive Brokers as well.
Yeah,
I
yeah,
would go for fractional shares. Then you can buy everything you want, and don't really worry too much about the €100 per month. You can just accumulate into stock. Also, when the stock costs like Google $2,500 or something like that. So I would try such a broker in that case.
cool. So Fire Pete has asked us, when you write covered puts, do you sometimes take earlier profits to write other puts, or do you always let your puts expire? I most of the time will try and take around 50 to 75% of profit, depends on a few things. Sometimes I might let them expire, but I I, I, I tend to take them early. So Pfizer, for example, I have an order in there. I I sold the put option, and straight away I set my target to 50%. So that will trigger out when it was quite close today. It might get there by Monday or Tuesday, I would imagine.
Yeah. So I do something similar. I think half of my covered puts, they I said they expire worthless, and the other half I buy back effectively. And why do I do that? I had it with the Viatris the other day. I bought it in 27 December, and I believe on 14 January it dropped to 10 cents or something like that for the option. So I made already like, I don't know, 40 cents in this case, and I bought two put options, sold two put options. So why wait another 1.5 month for the option to expire when it's trading at 10? I made almost all my profits already in 10 days. So then I have opportunity costs. I can unlock the money that was covered, right? And I can sell another put option again that is then again 50 or 60 cents and get that back to 10%. So usually when it really gets to those low digit numbers, the risk also becomes too big that there's a sudden price shock to the stock, and then suddenly you are still in the red. So then it take profits just.
Unless, of course, it's a company I want to own at a particular price. So, like I have Fresenius at 32. I could sell that now for quite a healthy profit, but I actually want to own them at 32. So I will hold
Yeah,
on and maybe hope that it drops.
exactly. But when the price is low, usually this because it's not going to
Yeah,
be called, right?
yeah, exactly. Tommy has asked for our comments on SAP's earnings. I mean, you gave your thoughts on that already. Jeff has asked us, in the US, we have CSX and UNP for trains. I think they're tickers and shipping. Is there any dividend payers in the same way in Europe?
So when it comes to trains, I'm not aware of it. You can go to train manufacturers like Siemens, but I believe that almost all the railway companies are semi-public in Europe or fully public. So I'm not aware of them. So otherwise, you would need to go to Siemens or such a company that builds trains. When it comes to shipping, what's the shipping company again called in Norway? The big one.
Oh, begins with a B. No, bunkers. I can't remember. I can't remember what it is.
Bunkers?
Like something I can't remember.
Okay, so I know that there. I will look it up and maybe we can put it in the description of the podcast. But I believe there is a company in Norway that is really big that also pays dividends. But sorry, Jeff, I don't have the knowledge present. Was good to know. We take these questions live in the show. We don't prepare too much for this. Sometimes we might skim through, but most of the times we just take them as they come. So no, my present knowledge can't give you an answer quickly.
I'm just trying to find that company's name quickly, and I can't. Okay, we'll try find it. But there was one in Norway that was tipped to us. It wasn't. It was a new enough company, I believe. So the dividend history is not quite there. So I don't know. We covered it before, but we'll try and post it in the notes here. Dave has asked us. He's watched your video on Intel's earnings. He knows you start a position. How big is it going to be in comparison to your current portfolio?
Relatively small, Dave, because I work with 4 tiers, and when I initiate a new position in company, it can never get to tier 1 or tier 2 directly. That's kind of the safety net I put in to not fall in love with a stock. Hence, I mentioned to myself that it will be maximum tier 3, which means it cannot be more than 2% of my portfolio if you look at it from the portfolio on which I want to retire. So it won't be my biggest position anytime soon, unless the company suddenly triples in price. Then it might grow into it, but not based on the cost. It will, for what I need to pay up, let's say.
We have one from dividend.exe, and he says, "Hi mates, how many hours do you guys spend on earnings, and what is the most important for you in the report?" And we can't say the obvious boring things like revenue, free cash flow, EPS, net income, and so on.
So I spend many hours on earnings, but not on a single company, right? So what I usually do is I read the first earnings bullets that every press release has, and then I go straight away to the 3 financial statements. I scan through the statements. If something catches my attention that is awkward, I'll go into the footnotes. That's how I do it when I'm, let's say, reading earnings releases. If I'm making investment decisions, I usually go much deeper and read few annual reports, like 1 or 2, 3 from the last years. I try to get a feeling for the company, how they've been evolving over those years, whether they are delivering on their promises that they do in the annual reports. And then you can easily say that I'm a week busy with a company. What I look at is revenue, free cash flow, EPS, net income, but I also look at working capital. I look at how much it is investing in R&D. I always like capex to be kind of around 30% of free cash flow. That's kind of a healthy balance, what I've observed in most of the companies. So yeah, you need to really look at this kind of stuff, but I also look at the balance sheet from a debt point of view. I mean, in the end, what I can tell you is that the 3 financial statements, they exist for a reason, and every individual financial statement has a flaw or shortcomings, but the 3 together shows you how the money moves and what's really the quality of the company. So I think every item in one of those 3 financial statements is important, and you have to learn a little bit accounting to understand that, because revenue can be manipulated, EPS can be manipulated, net income as well, and even free cash flow can be manipulated via working capital adjustments. So yeah, a lot of time.
Yeah. I spend a little bit of time as well, but I mean, I do some writing for Sure Dividend, which I've said before. I don't cover any of the companies I write for on my blog or podcast because it's separate and it wouldn't be fair to those guys. But I spend a good bit of time on that. I don't spend actually enough time on the companies in my own portfolio because of that, but I don't really need to. Only what we cover here on the podcast, I skim through them. I prefer to look at the annual reports. When the annual reports come down, I will read every one of them in my portfolio, and it'll take a little bit more time. To answer your question about what's most important, except for the obvious boring stuff, I'm always really interested in what the CEO writes and what they say. And there's always subtle hints, but I prefer to see him straight talking. I just want them to tell the truth, and that's what I'm looking for. Just honesty. If they've had a shit time, they can't really say that, right? But they can in in a way. They can always say we had huge pressures here, but here's where we're looking to improve. I just I just look at their sentiment and see what the actual feeling is, and you just get a real feel for the company then from there. So we have one then from Araz Detum, and he's asked us. This is a really hard question. I seen this earlier. What is the best company with the worst product, and the worst company with the best product? Okay,
Well, you want to, yeah, you get first.
right. I was going to say the best company with the worst product, right? And I'm going to be very biased here, but I'm going to say Apple because they're a brilliant company. But I don't use any Apple products. I use Microsoft or Windows, and I have Android. So for me, I try to use an Apple iPhone. It's completely alien to me. I try to use a Mac, and it just confuses me. So I mean, I hate those products because I don't use them every day. So that's my vote.
So for me, the best company with the worst product is ServiceNow. ServiceNow is this kind of company that everyone is cheering for, but I've seen it implemented in our company out of the box, and it's shit like hell. I mean, it's really not that much better than SAP or some of those companies. And the worst company with the best product is for me Uber. I love Uber. I would never invest in it.
Do you know, I was expecting you to say your Tupperware company that you invested in before, because I think that's a fantastic product. But the
Yeah, it
companies are,
is.
but
Yeah.
the company's obviously not great, and
Ah,
that
good
that
point. Yeah.
that's the company that came to mind for me.
Yeah. Good one. Yeah, that one I could also choose indeed.
Yeah. The next question is from Life with Dividends, and he wants to know about your thoughts about 3M, ticker MMM. Their stock price recently plunged after an earplug verdict went against them.
Yeah, so let's first think about the earnings, right? Earnings were actually quite good. They went up.
Yeah,
Nothing bad there. 3M is struggling already for 2-3 years, right, with having really lots of organic growth. I know that the company is an innovation powerhouse because last time I checked, let's say, what is it, 60 or 70% of their current products is only been around for 5 or 6 years because that's how much they innovate. So from an I said from a performance point of view, it did well, but then we get the earplug scandal, right? And we were talking a bit before the show about this 110 million verdict against 3M in the latest trial. But what I'm mostly scared about is that they have been filed by more than 250,000 veterans and military personnel. And if we know one thing, in well, at least what we see and observe from Americans, they have Veterans Day and everything. They
yeah,
really honor their veterans. So, and I always have a feeling like you don't bully with veterans in the US. So if you've got the veterans against you in a lawsuit, I think you're really screwed. And in the jury system in America, I think you're a double screwed.
yeah,
So I'm concerned about this risk, and I really don't feel happy with this.
yeah. I mean, it's quite interesting because I've started to analyze this company as part of my portfolio. So I said as one of my goals, I wanted to analyze each company, and I was starting with 3M. So I've just literally gone back through the last 15 years annual reports and taken all the figures from that. And as you said, I think last year was actually quite decent. Um, they were quite stagnant for the last 10 years. They were going from 29 billion up to 32 billion in 2020, and now we've had a jump to 35 billion. So we had quite an increase this year. The gross margin actually rose 7% on that basis as well. We know they were making a lot of gear with COVID, and that quite helped them, but it was still quite a good year. So from a numbers point of view, and if I was to look purely at the numbers, when I run them through my screen, I get a rating of 79, and that's great. But I mean, you just can't buy just based on numbers, and you have to think of the story, what happens in the future. And as we said, this could be something similar to Bayer with
Yeah.
Monsanto, and it could, or they could do. I mean, these guys are American; they might just do what Johnson Johnson does. They might be well used to litigation and say, "Screw you guys, we are spinning this company off," and then it goes away. And if they do that,
Yeah.
great. I mean, great, but um, it's concerning. Litigation and all this is always quite concerning. And as you said, the military in the US is, I mean, it's massive. I mean,
Yeah,
they salute them. I mean, it's particularly with veterans. Thank you for your service, and I'm sure they'll get huge sympathy from no matter what jury is up there and judge. I mean, if you're thinking who are you going to back, a veteran or a multinational company, there's only going to be one winner there. And
exactly.
if you're looking at these kind of numbers, I mean, they can soak up 110 million. You look at the free cash flow, it can go in there and it wouldn't do too much damage, but it's not that 110 million.
Exactly.
It's what can come after
It's
that.
the president that is setting here.
Yeah,
Yeah.
yeah. So we're going to see a lot more pressure on that share price. Incidentally, from my initial screener, it looks like they are below my fair value. I have them at about 173. So they look like they're at a good price, but they could easily drop 10-20% if this news keeps coming
Yeah.
out.
I truly hope that they will take the same lawyers as Johnson Johnson had, the same legal team. Don't be too stubborn. Just kick your current legal team out. Take the ones from Johnson Johnson and get it settled.
Yeah. I mean, look, I don't know too much about the story, and as an investor, you want them to do right by us, but as a person, if products have led to something, you would like to hope that these families get looked after as well. But I'm not American. I'm not in that. I'm an investor,
Exactly.
so I want them to just get it over and done with.
Good. This is the end of the show again. Thank you for all the questions, everyone. And I mean, there was some really funny and today here about the worst product and such. If you want to engage more of us, follow us on Twitter, but even on the Dividend Talk Facebook group, we have more than 400 members now. So that's quite a milestone again, EMF. So join these 400 members. There's activity going on, people chatting with each other, people sharing information with each other. Really nice place to be. But for now, spend some time with your family. Enjoy the podcast when you're listening to this. And see you guys next week.
See you on the outside.